Here we are in the last chapter of the semester, chapter 11. We're probably going to have 3 videos here for this chapter. And the topic is the gain or loss that we've already calculated back in chapter 10, but this time for only things called a capital asset. We're not going to be covering here in chapter 11 anything dealing with business or something called depreciation recapture. We're going to save those topics for next semester in our accounting, the second tax class, accounting 137, versus here in our accounting 134 class. So stick around for next semester, register for that 137 class, and we're going to review again chapters 10 and 11 because we're going to be covering business taxation in accounting 137. So let's define what is a capital asset that we're selling either at a gain or at a loss. And the way the tax law defines a capital asset is by what it's not. Again, here's the rule for capital assets. And examples of stuff that are not capital assets. So let's say that you're in a business that buys and resells merchandise. Sometimes we call that inventory. When you get a profit in selling inventory, that's not a capital gain. We call that ordinary income, taxed at regular ordinary tax rates. So if customers owe you money, sometimes we call that accounts receivable. And if you cannot wait to collect the money from the customer, but you want to get the money right away, what you can do is sell that receivable to a bank or some financial institution. And the profit you make, again, is going to be not a capital gain or income, but regular ordinary income tax at regular rates. So if you buy business property, or land for business, and then you resell it at a gain or loss, it's going to have special rules again we're going to be learning next semester. If you have a copyright that you've filed on your own or with patents for products you've developed, again, that's not a capital asset. Yeah. So anything usually else that you buy and sell would result in a capital gain. So typically, the thing that, let me give you some positive items that are capital assets. If you have investments, things like stocks in a company or bonds, not assets owned by the company itself, right? But you own ownership interest in a corporation or invest in bonds of a government or a company. Those investments are capital assets. So when you sell them, you're going to have a capital gain or a capital loss. Or items that you own personally, we call that personal use assets. Stuff like your personal automobile, your personal computer, your home. Although we learned back in chapter 10, if you sell your home at a gain, you may be able to exclude 250,000 on a joint return up to $500,000 of the gain. But that type of items you own for personal use and you sell it, that will result either in a capital gain, which is subject to taxation, or we also believe we learned in chapter 10, if you have a personal use loss, that loss is unrecognized. That loss is not deductible. Okay, so another way now we're going to be classifying capital gains and losses is by how long you've held the property before you sell it. We call that the holding period. If I can find the page for that. Holding period. So if you hold an asset for more than a year before you sell it, we call that long term. Yeah, if you hold it for a year or less, we call that short term. Again, 1 year, greater than 1 year, That's long term. And then less than a year or equal to 1 year, that's short term. So let me kind of give you the overall rule before we look at specific examples of now how we're going to combine items that are long term and items that are short term. So let me pull up here a blank piece of paper. So let's say we have one transaction and you've held it for more than a year and you made up profit. So the gain is called long-term capital gain. And if that's the only gain or loss item you have for the year, that gain is going to be taxed better than the other income you have. I believe back in chapter 3, we learned about something called qualified dividends that get taxed at lower rates. The same thing would be true with long-term capital gains. They get taxed at lower rates than the regular other income, taxed at regular rates. So let's say that you own something for more than a year and you suffer a loss when you sell it. We call that loss long-term capital loss. So what you would do is combine all the items you sell during the year at a gain and all the items you sell during the year at a loss, and we put them together. We call this netting to get a net long-term capital gain if the gains are bigger than the losses, or a net long-term capital loss. Okay, again, you combine gains and losses by not adding up the two, but taking the difference between the two. Now, if you have an item that you've held for a year or less than a year before you sell it, it's going to result either in a short-term capital gain or a short-term capital loss. And just like the long-term items, you would net out the short-term to get a net short-term capital gain or net short-term capital loss. So up here in the long term, you're either going to have a net gain or a net loss. Down here in the short term, you're going to either have either the gain or the loss. You're going to have both yet together because you're netting them together. Now, you're going to have up here, let's say that you have a net long-term capital gain, and in the same year, you have a net short-term capital loss. So what you're going to do is net out the gain with the loss. Or if you have a gain over here and a loss over here, you're going to net out both of these two, yeah, to get a smaller gain or loss. Now, the ultimate thing, what you want to have, again, is this long-term capital gain, more than any other type of income. But you gotta reduce it by this loss here to get this smaller gain or bigger loss. Or if you still have gain, again, you combine it with this loss, yeah, really this excess loss here. And if you still end up with a long-term net gain, we call that a net capital gain. I really wish we called it net because you net it out once over here and then you're netting it out once more over here with the short-term items. But this item right here, ultimately the long-term capital gains minusing out any losses, is going to be taxed either at 0%, which means tax-free, or for most taxpayers, they end up paying 15% on this net capital gain. Or for the wealthy taxpayers, they pay a 20% rate on this capital gain. So it is possible with all these different combinations, you have a gain over here and a gain over here at the same time. But it's only going to be this gain here that's taxed at the low rates. Or we don't want to suffer economic losses, But for tax purposes, losses are good because we get to subtract them. So if you have a loss here and a gain here, and you still have, when you net it out, you still have a loss. Or if you have both losses here and you end up with a lot of losses, up to $3,000 of capital losses can now be used to offset the other regular income of the taxpayer. Income like wage income, interest income, dividend income. You can reduce that income by this $3,000 deduction. Now, if you have more than $3,000 of capital losses, you're going to carry those unused losses to next year and add them to the loss here or over here. When you use this $3,000 capital loss deduction, the first loss you use would be this one here, the short term. If you also have long term at the same time, you use short term losses first against ordinary income up to 3,000. And then if you continually have losses, capital losses every year after using up 3,000 to offset ordinary income, you just keep on carrying it over to future, to the next year, and so forth until the taxpayer dies. Once the taxpayer dies, any unused capital losses disappears. I believe I had a client who had hundreds of $1,000s of capital losses, and they didn't have any capital gains to offset, but they did have some ordinary income, but he could only use $3,000 a year. So he had eventually passed away with a lot of unused capital losses. That's one of the things you may want to consider. If you have a bad investment, you may want to just sell stuff just to cash out and don't pay any taxes. If you have this type of losses, you can offset the capital gains. Let's take a look at some examples here of how we do some netting. Oh, before we do that, if you inherit property, automatically the person that the heir that receives the property, the person that receives the inheritance, will treat that property as long term. Okay, automatic, yeah, long term. And we learned back in chapter 10, there may be also property that was gifted from a so-called donor to donee. And if the cost basis carries over, transfers over from the donor to donee, then the holding period of the donor can be tacked on to the holding period of the donee, probably causing the donee to have a long-term holding period. So let's go through some examples here of how we do the netting process. So in this example, we have either 4 transactions or 4 groups of transactions where we have a gain here and a gain here, but one is short term and one is long term. And then we have losses for short and long term. So the first step is to group all the short term items together, here resulting in a net short-term capital loss. And then we group the long-term items together, resulting in a net long-term capital gain. So the next step is to combine these two together. Yeah, long-term gain, short-term loss. So we subtract out the loss from the gain, resulting in, again, we call this a net capital gain. And again, this is the item that gets taxed at the lowest rates at 0, 15, or 20% versus the higher rates the other income is going to be taxed at. Next example, again, we combine short-term items to have a loss and a long-term items, and now we have also another loss. We can combine it to get a $5,000 loss and eventually report it on something we're going to see in our last video called a Schedule D. But Remember now, when we have capital losses, we can use up to $3,000 of the losses to offset. It's just coincidentally this is 3,000, but $3,000 of capital losses can be used to offset ordinary income, and we use short term first before the long term losses. Yeah. So in our case here, we're going to deduct $2,000 of the loss and $1,000 of this long-term loss to get 3,000, and then that leaves $2,000 of the loss to be carried over next year to offset other long-term gains. Let's take a look at this next example. We have, looks like, three short-term items, sales, resulting in a short-term gain. And then we have two items for long-term, resulting in a long-term loss. Again, now we net out the short and long-term to get a net short-term capital loss. And sorry, this is a gain, not a loss. And short-term capital gains are taxed at regular rates, like what you're taxed at for your salary or interest, yeah? Okay. Versus long-term, if you had a gain over here, usually that would be taxed at lower rates. Again, we would call that net capital gain, yeah? Taxed at lower rates. Net short-term capital gains taxed at regular rates. Here's that term I just mentioned that it gets taxed at lower rates, net capital gains. And the rates it gets taxed at could be 0 or could be 15%, or for the wealthy taxpayers at a high 20% rate. So here's an example of calculating now the tax. So we have Abby, who has a total taxable income. This would include now the net capital gain of 135,000. We're told her net capital gain included in that 135 is 15,000. So to calculate out her tax liability for the year, here it says 2018, but I think it's close to 2019 calculations here. So we take the taxable income and we subtract out the net capital gain. So the rest of the taxable income is going to be taxed at the regular rates. So if you remember back in chapter 2, the way we calculated out regular taxes is to either use the tax table if the taxable income were under $100,000. In her case here, it's 120. So what you got to do is use the tax rate schedule. So let me just show you. I'm not going to go through the detailed calculations, but just show you the tax rate schedule here. Typically, it's in the instructions for the 1040 form, and I always kind of remember it's kind of close to page 100. So if you just search near page 100, you're going to see this tax rate schedule. And in the case of Abby, like a single filing status, you would look up her taxable income in this two columns here and then go across. I think we're falling in this row right here. And her so-called marginal, her highest rate here would be 24%. But she still gets the benefit of 10% of this bracket and 12% of this bracket and so forth. It's only anything over 84,200 gets taxed at her marginal rate of 24%. And you can see it's higher than the 15% bracket that her net capital gains are going to be taxed at. So you would use this table to figure out her regular tax. And here in this example, they say it's this 22,975. Again, I'm not sure if they're using the 2018 or 19 rates here. But then her net capital gains of 15,000 gets taxed at 15%. So that comes out to $2,250. So here's the total tax she has to pay for the year versus having to report all of this 135,000 using this tax rate schedule and being taxed on her dividends at 24%. So she's saving 9% of taxes because of her capital gains are taxed at this lower 15%. If you remember, I mentioned that capital gains can be either taxed at 0, 15, or 20. So how do we know in her case it's 15 and not 0 or not 20? There's another rate schedule. Again, this rate schedule here is for taxable income that's not including any capital gains. So there's another rate schedule, and it's summarized in our book. Well, really not summarized, but listed in our book over here. See this paragraph with all these amounts and that 0, 15, and 20% rate. So I've summarized it in this spreadsheet here that's linked in our Laulima chapter resources folder. So in the case of single filing status, if the taxpayer's total taxable income that includes the net capital gain is under 39,375, then all of the net capital gain is taxed at 0. But in the case of, I believe it was Abby, our example, her taxable income was 135,000 that falls inside of here. So all of her 15,000 of capital gain taxed at 15%. So you can see different brackets here, much less brackets than the regular taxable income for different filing statuses. So the broad bracket is this 15% bracket. You can see how wide the bracket is. Only if a single person goes over taxable income of 434,000 would any of the capital gains be taxed at 20%. Again, this calculation also applies for qualified dividends that we learned back in chapter 3. So we're going to go in our last video for this chapter, the actual form to calculate all of this, yeah? Let's look at another example here. I had to correct this example 12 where you have to kind of know that bracket amount, because if the capital gain, in this case 15,000, kind of overlaps the 0 bracket and the 15% bracket, you need to know how much is taxed at 0, yeah, and how much is taxed at 15. In the case of that Abby's example, previous example, all of it was taxed at 15. Yeah. You can take a look at this example 12, yeah, and I posted up the correction in our Laulima site. There's it's off here. This paragraph up here is correct, but the calculations down here are using wrong amounts. Let's continue here. So if you now have a net capital loss, up to 3,000 of that loss can be used to offset other ordinary income of the taxpayer. Although married filing separate, you only get to deduct 1,500 per year. And again, any excess losses after that you carry over to future years. Short-term capital losses are used first before any long-term capital losses for this $3,000 deduction. So here's an example. We combine the short-term items to get a net short-term loss. We combine long-term items to get a net long-term loss. So you use short-term losses first. So 3,000 of this 9 is going to be used. So 6,000 is now going to be carried over to next year to offset next year's short-term gains. And this 2,000 here of losses, we're not going to use any of it this year, but just carry it over to next year to offset long-term capital gains. So there's different combinations, yeah. So here's just 1,000 of short term, and then you're going to use 2,000 of this long term to get a total of 3,000. And then only 3,000 looks like it's left for long term carried over to next year. You notice in this example, it includes even older capital losses carried over to this year, and you use them first, yeah, first before any of this loss is being utilized to offset ordinary income. Okay, let's stop here. And in the second video, we'll talk about some certain situations where we can possibly exclude gains or losses.